Hey everyone, today we're talking about what it actually takes to access the equity you built in your home without refinancing. Because if you've looked into a HELOC or been turned down for a loan, there is a reason it felt stacked against you. A lot of the tools out there only work if you check every box. Great credit, steady income, low debt. But if you're retired or self-employed or just going through a rough patch in life, those rules don't leave all that much room. So in this video, I want to walk you through every major option that's available today, including one that you may not have come across yet. We'll cover how each one works, what the trade-offs look like, and where it might or might not fit depending on your situation. So for most people trying to tap into their home equity, the first suggestion they'll hear is a home equity loan, or HELOC. And on paper, they're simple. You already own the home, you've got value built up, just borrow against it. But in practice, that only works if you meet some very specific requirements. You need at least 15% equity. Your credit score has to sit somewhere between 620 and 680, maybe even higher. You need low existing debt, steady income, and clean paperwork to back it all up. And the moment anything falls outside that box, things start to fall apart. You pick up the phone, run through all the paperwork, and a week later they come back with, your DTI is too high. Not because you're reckless, but because you already used credit cards to stay afloat. Or you're retired and you don't have the income to qualify. Or your self-employment taxes make your income look smaller than it actually is. And even if you do get approved, there's a monthly payment. It's fixed or variable, but either way, it's another bill to manage. Plus, if the money is going toward medical costs, education, or debt relief, you won't get any tax benefit. The IRS only allows interest deductions when the loan is used to build, buy, or improve the home itself. So it's a great option for the right kind of borrower. It's just that the pool of right borrowers is really small. So if a second mortgage isn't an option, the next category you'll hear about usually sounds more promising, where there's no income check, no monthly payments, and no new loan to manage. But each one is still going to take something from you. A reverse mortgage is meant for homeowners over 62. It lets you tap into your equity without selling, and you don't have to make payments while you stay in the home. But the debt doesn't just disappear, it builds over time, adding interest, fees, servicing costs, until it gets repaid all at once. And that happens when you sell, move out, or pass away, and at that point, your estate gets the bill. If your kids want to keep the house, they might have to come up with the full amount just to hold on to it. And then there's the Sale-Leaseback Model. That one's available at any age. You sell your home to an investor and stay in it as a renter, usually under longer term lease. But obviously, you've now given up the title, the future appreciation, the control, and that monthly rent doesn't just go away. So yeah, these models give you access to your equity, but they also remove all the long-term flexibility. You trade away ownership for cash, and once it's gone, it's really hard to get back. For a lot of people, that's just too steep of a trade. So once you've ruled out loans, reverse mortgages, and leasebacks, there is one model that tends to come up. It's called a home equity investment, or HEI, and it works a little bit differently because there's no loan to repay, no interest to track, and no monthly bill. Instead, you're receiving a lump sum upfront, and in return, the investor gets a share of your home's future appreciation. So you still live in the home, you're still listed as the owner, and because there's no debt involved, you're not being evaluated based on your income, credit score, or DTI the way you would with a traditional lender. 10 years from now, you sell it for $650,000, and that's when the agreement settles by repaying the $75,000 plus a fixed portion of the increase in value. And some providers will even share in losses. So if the home drops in value, what you owe could be even less than what you borrowed. Now, it does still get recorded as a lien, and if you refinance during the term, the investor has to sign off to keep things in place. But aside from that, there is nothing active to manage because you're not paying interest, nothing builds month to month. It's just a longer term agreement based on future value, not your current finances. Now, one thing that doesn't always get brought up with these is how they work on the tax side. With a traditional loan like a HELOC, the interest might be deductible if you're using the money to improve the home, but since this isn't a loan and there's no interest, that deduction doesn't apply. Even if you put the money into repairs or renovations, it's still treated more like a partial sale. So the tax benefits you'd normally get with a loan just aren't part of this setup. And while the overall structure is pretty simple, the legal side isn't totally settled yet. The IRS hasn't given formal guidance on it. In some cases, courts treat these like mortgage products, and that part could change down the line depending on how the rules shake out. So it's not a deal breaker, but if tax deductions are something you were planning to factor in, it's just good to be aware of. Now, If you're looking into home equity investments, one of the names you'll run into is Point, and what makes Point stand out is how easy it is to qualify. There is no income requirement, no debt to income checks, and the credit score cutoff is super low, like 500. So if a traditional loan isn't really an option, this could be a way to still unlock some of the equity you built. Depending on how much equity you've built up, you can access up to $600,000. And like we talked about earlier, there is no monthly payment, and nothing builds up while the agreement is active. Now, it's worth it to go over the math on this. Before anything is finalized, Point will apply something called a home value risk adjustment. Totally standard, but that lowers the appraised value sometimes as much as 27% before they calculate their share of any future gain. So if your home appraises at, say, $500,000, they might use $365,000 as the starting number. That way, when the property sells or gets refinanced later on, the appreciation kicks in from that adjusted value. There's also a one-time processing fee up to 3.9% or a $2,000 minimum, plus the usual closing costs like appraisal and escrow. And if you put any money into renovations during the term, any increase in value will get shared as well, even if you pay for the work yourself. So it's a flexible setup, and for the right person, it can be a really useful option. You just want to go in knowing how the numbers are going to play out over time, because most of the cost here doesn't show up until later. So stepping back for a second, here's what the landscape really looks like. If you've got strong credit, steady income, and a low debt load, traditional options like a home equity loan or HELOC tend to be the most straightforward. You're making monthly payments, you're paying interest, but the setup is familiar. And if the funds go towards some home upgrades, it might even help your taxes. If you're over 62 and fully retired, a reverse mortgage lets you tap into your equity without a monthly bill, but the balance grows over time, and it gets repaid when you move out or sell the home. Sale-leasebacks are an absolute last resort option for some. Immediate liquidity, yeah, but you lose the title and your home becomes a rental. It works, but there's a big shift in control there. And then there's the equity investment route. No monthly payments, no income requirements, no accumulating debt, but you are giving up a slice of the future. And depending on the terms, that slice might end up being bigger than it looks up front. See, each one of these solves a different kind of problem. The key is just knowing where the costs land and whether they show up now or later. So hopefully this gave you a better sense of what's actually out there and how to think through the trade-offs depending on what you'd need. And if Point feels like it might be the right fit for your situation, there's an affiliate link down in the description. It doesn't cost you anything extra to use, but we might get a commission on it, and it really does help support the channel. Also, sometimes we can get you some special offers there that you won't find on their main site like at all, so feel free to check that one out. Also, if you're interested in working with us or sponsoring a future video, please just reach out using the email in the description below. If you found this helpful, I would really appreciate a thumbs up and subscribe for more insights like this. As always, if you got any questions, I'd love to hear them. Just leave a comment below and I will do my best to help. Otherwise, thank you so much for watching, and I will see you in the next one.